Please subscribe, like, and share. It really helps us out. And of course, if you have any questions, comment below and we will answer you as soon as we can. Hi everyone, welcome back to our accounting series. In this video, we're exploring two crucial concepts: the effect of profit on capital, and how the double entry system works for expenses and revenues. By the end of this video, you'll see how these elements fit together like pieces of a puzzle in accounting. Let's dive right in. First, let's revisit the accounting equation. Capital represents the owner's investment and the retained earnings of a business. Now, here's where profit comes into play. Profit increases capital. When a business earns revenue, it adds to capital. But when a business incurs expenses, it reduces profit, and by extension, reduces capital. Imagine a business starts with $20,000 in capital. During the year, it earns $10,000 in revenue, and it incurs $4,000 in expenses. Here's the calculation. Profit equals revenue minus expenses. The profit therefore is equal to $10,000 revenue minus $4,000 in expenses. Or, $6,000. This $6,000 profit adds to the initial $20,000 capital, giving us a total capital of $26,000 at the end of the period. So let's show the effect on the accounting equation. Assets equal liabilities plus capital, which is now $26,000. See how profit strengthens the financial position of a business? Now, let's explore the double entry system for recording expenses and revenues. Every transaction in accounting has two sides, a debit and a credit. Let's start with revenues. Revenues represent money earned by the business, increasing profit and, therefore, capital. When recording revenue in the double entry system, do the following. Credit the revenue account. This increases income. Debit the cash or accounts receivable account. This shows an increase in assets. Let's do an example. A business earns $5,000 by selling goods for cash. So, debit the cash account, $5,000. Then, credit the revenue account, $5,000. This keeps the accounts balanced and reflects the increase in both income and assets. Now, let's talk about expenses. Expenses reduce profit, which in turn decreases capital. When recording expenses, debit the expense account. This shows the cost incurred. Then, credit the cash or accounts payable account. This shows a reduction in assets or an increase in liabilities. Let's look at an example. A business pays $2,000 for rent. Firstly, debit rent expense account by $2,000. Then, credit the cash account by $2,000. This entry reflects the reduction in assets and the increase in expenses. Now, let's connect the dots. Firstly, revenues increase profit, which adds to capital. Secondly, expenses decrease profit, reducing capital. Lastly, the double entry system ensures that every transaction is recorded in two places, maintaining the balance of the accounting equation. Here's a quick recap. 1. Profit directly impacts capital. Revenue increases profit and capital, while expenses reduce them. 2. In the double entry system, revenues are credited, and the corresponding asset, like cash, is debited. Expenses are debited, and the corresponding liability or asset reduction is credited. 3. Together, these principles ensure accurate, balanced, and reliable financial records. Thanks for watching. If you enjoyed this video, give it a thumbs up and subscribe for more accounting tips. Got questions about today's topic? Drop them in the comments below, and I'll be happy to help. Until next time, keep those books balanced. Thank you for watching our video. Please like, subscribe and share. And comment below so we can clarify things for you.